New York City, February 1950. A man named Frank McNamara is finishing dinner at Major's Cabin Grill. He reaches into his pocket and freezes. The wallet isn't there. In that moment of embarrassment, McNamara didn't just offer to wash dishes. He decided to change the nature of debt. He wrote his signature on a cardboard card, promising to pay later. Historians call it the First Supper, but they miss the point. That night, money stopped being a physical object you own and started being a data trail you leave behind. For 5,000 years, a transaction was strictly between two people. After that dinner, there was always a third person in the room, watching, recording, and eventually, controlling. And eventually, the cash in your pocket is silent. The card in your hand never stops talking. Take a moment to look at a $20 bill. Really look at it. It is a fascinating piece of technology, not because of what it can do, but because of what it cannot do. It has no memory. It does not know who held it yesterday. It does not care who you give it to tomorrow. It has no GPS, no user log, and no terms of service. If you drop it on the sidewalk and someone else picks it up, it becomes theirs instantly. No password required. In the world of high finance, we call this a bearer instrument. This is a legal term that has almost vanished from the modern vocabulary. It means the value is in the object itself, not in a record stored somewhere else. Whoever holds the paper holds the power. For centuries, this was the default setting of the global economy. If you wanted to buy a house in 1920, you could bring a suitcase of cash. The seller counted it. You shook hands. The house was yours. The bank didn't know. The taxman didn't know. The government didn't know. The transaction was peer-to-peer before the internet ever existed. It was the purest form of financial privacy. In this era, money was private property, and I mean truly private. When you held gold, or a certificate redeemable for gold, you were not asking for permission to spend it. You were not relying on a Visa server to be online. You were not hoping a bank manager approved your purchase. You were sovereign. The system was designed to respect the holder of the asset. The assumption was that your money belonged to you, and what you did with it was your business. Now, try to do that today. Walk into your local bank branch tomorrow morning. Ask to withdraw $10,000 of your own money in cash. Watch the atmosphere in the room change. The teller will stop smiling. A manager will be called over. They will ask you what you need the money for. They will type your answers into a database. If you refuse to answer, or if they don't like your tone, they are legally required to file a suspicious activity report to the federal government. In less than a century, we have successfully rebranded privacy as suspicion. We have turned the act of holding your own property into a potential crime. The system didn't change overnight. It changed language first. It convinced you that anonymity is only for criminals, and that transparency is for good citizens. But transparency only goes one way. You are transparent to them. They are opaque to you. So why did we accept this? Why did we trade sovereignty for surveillance? We didn't do it because we loved big banks. We did it because of a simple flaw in the design of freedom. Freedom is heavy. Gold is heavy. Cash is bulky. Protecting your own assets requires physical effort. And the human brain is wired to seek the path of least resistance. We didn't want to carry the weight anymore. We wanted magic. We wanted to move value across the world without leaving our chairs. And the industry was ready to sell us exactly that, at a price we didn't bother to read in the fine print. The year is 1958. In Fresno, California, 60,000 residents open their mailboxes to find a strange gift. It is a small piece of plastic from Bank of America. They didn't ask for it. They didn't apply for it. It was simply there. History calls this event the Fresno Drop. It looked like a generous experiment in consumer credit. In reality, it was the deployment of a Trojan horse. Before this moment, if you bought a suit, the transaction was between you and the tailor. It was a private contract. But the card introduced a radical new architecture. It introduced the middleman. Suddenly, the relationship was no longer A to B. It was A to B through C. And Party C wasn't just facilitating the payment. Party C was taking notes. This is the birth of the surveillance economy, though nobody called it that yet. For the privilege of spending money you didn't have, you agreed to let a corporation sit at the dinner table with you. Every time you swiped, you sent a signal: where you ate, what hotel you slept in, how much you spent on liquor, how often you traveled. The bank didn't just want the interest fees. They wanted the pattern. They realized that a man's spending habits tell you more about his future than his diary ever could. This was the quietest revolution in history. We traded privacy for convenience. We traded anonymity for a credit score. We invited the spy into our pockets because he offered to pay the bill. Wall Street calls this risk management. A forensic analyst might call it voluntary espionage. We think of the credit card as a tool that serves us. That is a charming illusion. To the system, you are not the customer. You are the data point. The merchant pays the fee. You provide the information. It was a fair trade by their standards. You got a television. They got your life story. But even with the surveillance grid being built, there was still one problem for the architects of this new world. The money itself was still real. The dollar in 1965 was still tethered to gold. It was a claim on a physical asset sitting in a vault. As long as money was physical, the middleman's control was limited. He could watch the flow, but he couldn't control the source. The system was ready. The pipes were laid. The surveillance cameras were on. They just needed to cut the anchor. And that anchor was cut on a Sunday evening, when the most powerful man in the world walked onto television to break a promise. Sunday evening, August 15th, 1971. Most of America is sitting in front of the television, waiting for the popular Western show Bonanza to begin. Instead, the screen flickers. The show is interrupted. President Richard Nixon appears. He looks serious, almost nervous. He didn't interrupt prime time to announce a war. He didn't announce a peace treaty. He announced a default. He told the world that the United States would temporarily suspend the convertibility of the dollar into gold. Temporarily. That word is doing a lot of heavy lifting. In that precise second, the global financial system mutated. Before 1971, a dollar was a claim check. It was a receipt for a specific amount of gold stored in a vault. It was an asset. After 1971, the dollar became a liability. It became a debt instrument issued by a government that promised to pay you with more paper. This is the moment the digital age truly began for money. Long before the internet, money had already become virtual, because once you remove the physical anchor, once you remove the gold, money becomes nothing more than a number. It becomes an abstraction. It becomes faith. And unlike gold, faith has no physical limit. You can't print gold, but you can print faith, until it becomes worthless. This detachment gave the central planners a superpower they had dreamed of for centuries. They could now manipulate the supply of money without digging it out of the ground. They call it monetary policy. You might know it by a different name: inflation. We are taught that inflation is a complex economic phenomenon, or a greedy corporate strategy. But looked at through the lens of 1971, inflation is simply the system working exactly as designed. It is a feature, not a bug. It has been over 50 years since Nixon promised that suspension was temporary. 50 years is a very long time for a temporary measure. But by the time the public realized the window was never opening again, it was too late. The transfer of wealth had already happened. The money in your pocket had been replaced by a ghost. But here is the catch. When money becomes weightless, when it becomes just a signal, it needs a new way to travel. It no longer moves in armored trucks. It moves through wires. And whoever owns the wires, owns the world. Brussels, 1973. While the world was distracted by oil crises and wars, 239 banks quietly gathered in a room. They didn't build a vault. They built a language. They created SWIFT. Before this, moving money across borders involved telex machines and confused operators. After this, it became a standardized message. But don't mistake messaging for movement. When you tap send on your phone today, you think your money travels instantly to the recipient. It doesn't. You are simply sending a text message that says, "I promise to pay you." The actual money takes the slow road, and that road is called Fedwire. If SWIFT is the messenger, Fedwire is the armored truck, owned and operated by the Federal Reserve. This is the spine of the American economy. The numbers are difficult for the human brain to comprehend. In 2022 alone, this system processed over $1 quadrillion. That is a 1 followed by 15 zeros. To protect this staggering amount of wealth, they didn't just buy a firewall, they built a fortress. Fedwire relies on 3 separate processing centers, geographically isolated by hundreds of miles. They have a primary site, they have a hot backup ready to take over instantly, and they have a warm backup for regional catastrophes. It is engineered to survive earthquakes, hurricanes, and nuclear fallout. It is the ultimate expression of centralization. Stable, heavy, unshakable, or so they thought. Because while they were building walls to stop physical disasters, they forgot that the new threat doesn't knock on the door. It comes through the wire itself. Enter the Lazarus Group, a state-sponsored hacking syndicate linked to North Korea. They didn't need an army to attack the financial system. They just needed code. In 2016, they compromised the Bangladesh bank and tried to move nearly $1 billion. In 2022, they struck the crypto world, draining $615 million from the Ronin network. Here is the supreme irony of our digital age. You work 40 hours a week for 40 years to accumulate a number in a database. You trust that number is safe because it is guarded by the Federal Reserve's 3-layer infrastructure. But in the digital realm, $1 billion can evaporate in the time it takes to blink. The fortress is designed to protect the system from collapsing. It is not necessarily designed to protect you from being emptied. By the year 2000, the highway was complete. The infrastructure was solid. The invisible pipes were laid connecting every bank, every merchant, and every wallet. The trap was set. They had the means to move money anywhere. Now, they just needed a reason to watch it everywhere. And on a Tuesday morning in September, history gave them exactly that excuse. September 11th, 2001. The towers fell, and with them so did the old world's concept of privacy. 45 days later, while the dust was still settling, the USA Patriot Act was signed into law. Most people think this was about airport security and wiretapping terrorists. But in the fine print, it fundamentally re-engineered the banking system. It introduced a mandate that sounded innocent enough: know your customer, or KYC. Before 2001, a bank was a vault where you stored your wealth. After 2001, the bank became a deputy of the state. Every teller became an intelligence officer. Every transaction became a potential crime scene. If you deposit just a little too much cash or move money a little too often, algorithms flag you. They call it anti-money laundering, or AML. It sounds noble. Who wants to help drug lords? But in practice, it means that you, the law-abiding citizen, are treated as a suspect until proven innocent. Your innocence is no longer assumed, it must be verified. Transaction by transaction, this created the digital panopticon. Total visibility for them. Zero privacy for you. But here is the dark twist. While they were busy building a surveillance grid to watch your coffee purchases, they forgot to secure the front door against the new age of thieves. Technology didn't just help the banks, it helped the predators. In 2020, a bank manager in Hong Kong received a call from a company director he had known for years. The voice was perfect, the tone was familiar, the instructions were urgent. He authorized a transfer of $35 million. He wasn't talking to his client, he was talking to an AI. Cybercriminals had used deep voice technology to clone the director's speech patterns. No gun, no mask, just a synthetic voice and a trusting system. This is the fragility of the digital cage. The system is incredibly efficient at freezing your account because you forgot to update your ID. But it is terrifyingly vulnerable to a hacker who knows how to speak its language. We built a fortress to keep the citizens in check, but left the keys under the mat for the machines. So we have lost our privacy. We have lost our anonymity. And we are constantly at risk of digital theft. But surely at least the money itself maintains its value, right? Surely the dollars being surveilled are stable? That was the last illusion to fall. Because while the security state was watching the flow of money, the central bankers were quietly destroying the value of money. And they didn't need a hacker to do it. They just needed a crisis. September 15th, 2008. The heart of the global financial system skipped a beat. Lehman Brothers collapsed. Credit froze. For a few terrifying hours, the people in charge stared at a screen that showed the end of the world. The ATMs were days away from running dry. To save the system, the Federal Reserve had to do something that had never been done on this scale in human history. They needed money, trillions of it, fast. But here's the misconception. People say the Fed printed money. That brings to mind images of ink, paper, and noisy machines whirring in a basement. That is a myth for children. In 2008, and again in 2020, they didn't turn on a press. They simply sat at a computer terminal and typed. They entered a number into a spreadsheet. They hit enter. And just like that, billions of dollars were born, created from absolutely nothing, backed by absolutely nothing. They call this quantitative easing. It is a sterilized academic term designed to sound boring, so you don't ask questions. But look at the year 2020. In response to the pandemic, the central banks went into overdrive. Nearly 40% of all US dollars in existence were created in a single 12-month period. Think about that. It took 200 years to create the first 60%. It took 1 year to create the rest. When you create that much currency without creating new goods or services, you are not creating wealth. You are diluting it. You are taking a teaspoon of wine and pouring it into a barrel of water. The barrel is fuller, but the wine is gone. This is why the stock market hits all-time highs, while your grocery bill doubles. The money has to go somewhere. It flows to assets first. Stocks, real estate, gold, making the rich richer. By the time it trickles down to your paycheck, it has lost its power. There is a supreme irony here. If you print money in your basement to pay your bills, it is called counterfeiting, and you go to prison for 20 years. If the central bank does it to bail out a corporation, it is called monetary policy, and they get a Nobel Prize. The mechanism is the same. The only difference is who holds the keyboard. We have moved from gold to paper, to plastic, to pixels. Each step made money easier to move, but each step also made it easier to manipulate. But the final step isn't just about creating money from thin air. It's about controlling how that money is used once it leaves the computer. The printer is infinite. Now they need to make sure the cage is inescapable. If you take the time to read the white papers published by the IMF or the Bank for International Settlements, you will notice a new phrase appearing with alarming frequency. They don't call it surveillance, they call it programmable money. This is the final frontier. It is the birth of central bank digital currencies, or CBDCs. Now you might ask, I already use Apple Pay. I already use digital banking. What is the difference? The difference is the architecture of control. Right now, the money in your Chase account is a digital record of a promise. It is passive. It sits there until you decide to move it. CBDCs are active. They are code, and code can have rules. Current money allows you to buy anything that isn't illegal. Programmable money allows you to buy only what the issuer permits. Imagine a stimulus check sent to your phone during a recession. But this time the code carries a condition. Must be spent within 30 days. If you try to save it, it vanishes. Imagine a carbon footprint limit attached to your wallet. You try to buy a plane ticket or a steak, and the transaction is declined, not because you lack funds, but because you have exceeded your carbon allowance for the month. This is not science fiction. These features are being tested in pilot programs right now. They can geofence your money, making it work only within 5 miles of your home. They can restrict it by merchant category. They can turn your wealth off with a keystroke if your social credit score dips below a certain threshold. Under this system, you are no longer the owner of your money. You are merely the custodian of a government voucher. And vouchers can be revoked. Of course, the sales pitch will be beautiful. They will tell you it is for your safety. They will say it stops tax evasion. They will say it is inclusive, fast, and fee-free. And they are right. It will be safer. Consider the mouse in the laboratory cage. It is perfectly safe. It never has to worry about predators. It receives free food every day. It has healthcare. The mouse is secure, but the mouse can never leave. We are standing at the threshold of a cashless society. It is clean. It is efficient. It is convenient. But before we take that final step, we have to ask ourselves one question. When the last paper bill is burned and every transaction requires permission, do you actually own anything? Or are you just renting your life from the people who hold the server keys? Looking back, the history of money is essentially a history of separation. First, they separated money from gold. Then, with systems like Fedwire moving quadrillions of dollars through the dark, they separated money from the bank vault. And finally, right now, they are separating money from you. The system we have built is a marvel of engineering. It is seamless. It is fast. It is magic. But we forgot that friction was the only thing protecting your privacy. Cash was clumsy. It was dirty. It was heavy. But it was yours. When the last dollar bill is retired, every transaction you make will cease to be a right. It will become a request, a permission slip sent to a server you do not control. You will no longer be the owner of your wealth. You will be a user of their ledger. And as we know from the digital world, users can be banned. I'm not telling you to hide gold in the garden. That world is gone. I'm just saying, the next time you tap your phone to buy a coffee, take a second. Ask yourself, whose money is it, really? If you want to understand the patterns history uses to trap the unprepared, hit subscribe. I'll see you in the next file.